Hello and welcome back to Game of Trades, your #1 channel for videos on the stock market and cryptocurrencies. This video is going to be focused on the S&P 500 and more specifically the valuations of the S&P 500. I'm going to be taking you step by step through why the S&P 500 is currently extremely overvalued relative to historical measures and why it guarantees that we're going to see lower returns throughout the next 10 years. We're going to be going through a bunch of data in this video. We're going to do it very differently to how a lot of people usually view this data. And we're going to start with this ratio here, the PIE ratio of the S&P 500. Now, this is basically a classic PE ratio, but it's been adjusted for inflation. Now, we talked about this in a recent video, and it's currently showing we're at historical valuations, even higher than the dot-com bubble, higher than in 1929. Now, by itself, this doesn't really mean anything. That's why you're seeing a lot of people say, oh, well, valuations don't really mean anything anymore. You've got technology, you've got a lot of different types of stocks that you didn't have before, unprecedented liquidity. This is just not comparable to anything we've seen throughout history. But this is where I want to show you the PIE ratio relative to the 10-year forward return. This is a fascinating chart because it shows you the correlation there is between this PIE ratio and the actual 10-year forward returns. So let's dig into what this actually means. This is telling you if you had invested back in 2012, considering where the PIE ratio was back then, you could have expected around a 10% annual return over the next 10 years. That's huge numbers. That's higher than the average total return of the S&P 500. And that's more or less what actually happened. And you can see how good that prediction was with the red line. And it more or less predicted that returns over the past 10 years have been at around 13% annualized. We can do the same exercise right here. If you had bought the S&P 500 in 1999, considering that PIE ratio was at 1.58, it told you that your 10-year expected return was at around -6%. So you would have lost 6% of your purchasing power per year throughout the next 10 years by holding the S&P 500. And you can see this correlation has just been almost perfect throughout the past 100 years. So this is quite a scary chart we have right here, considering the fact that in 2022, we have this indicator telling us we're currently nearing a -10% annualized return for the next 10 years. So if this continues playing out as it did throughout the past 100 years, it's telling us that investors entering the market right now can expect to lose 10% of their purchasing power every year throughout the next 10 years. That is some scary number right here. Now let's look at valuations in a different way this time. We're going to take a look at stock market asset allocations. So how US investors are positioned into the stock market or not. And you can see it's pretty much the same exact chart. You can almost see there's absolutely no difference between this chart and this chart right here, when it's actually not at all the same data set. We're talking about asset allocation here. So how much investors are positioned into the stock market. And you can see when that's low, when there's not many people invested into the stock market, it gives you a lot of potential for price appreciation. For example, here in 1992, if you had invested into the S&P 500, your expected return was at around 20%. And if you look at what actually happened, so the blue line, it was accurate. It gave you around 18% annualized return over the next 10 years. And so stock market allocation right now is above 50%. So very near the type of allocation we had in the dot-com bubble. Again, if this relationship holds true, which it has right up until now, it's been a perfect correlation between the two. It's telling us that our 10-year forward expected returns are negative. So we're going to be losing purchasing power every year for the next 10 years. Now, forward expected returns are extremely low here, very similar to what they were in the late 1960s and in the late 1920s. Now, both of these dates were followed by incredibly volatile market conditions. And that's how low forward expected returns manifest themselves through volatility. In the 1930s, you had two crashes that were over 50% drawdowns. In the 1970s, you had very volatile swings on the S&P 500. If you add the consumer price index on this chart, you can see the 1960s were actually a lot more volatile than the nominal chart suggests. In nominal terms, it doesn't look that bad. It barely looks like the S&P 500 went down throughout that period. But when you adjust it for inflation, look at how violent that looks. Between 1965 and 1982, you had a 64% drawdown. And that's over the course of 17 years. Over 17 years, you would have lost 2/3 of your purchasing power by holding stocks. So it makes me laugh when I hear that stocks only go up and that you just should hold forever and not pay attention to valuations. It's incredibly important to pay attention to valuations. And that's exactly what I'm trying to demonstrate in this video. I don't know about you, but personally, I don't have 17 years to wait to make money. At least those are not my intentions. In fact, it's not even 17 years before you make money. It wasn't until 1995 that you actually started to make a return on your investment, right? So that's 30 years before you're in the green relative to inflation. Are you ready to hold your investment for 30 years before it actually begins to yield some return? And the crazy part about all this is that YouTubers out there that tell you that just keep your money in the stock market, don't pay attention to valuations, don't pay attention to any type of bearish talk, they're the ones that sound reasonable now. And that's typical investor psychology, because people just look at what's been happening over the past 10 years and they don't put it into a historical context. Now, if you're a fan of history and you like the way we're reasoning in this type of crazy market environment, I'd strongly suggest you go ahead and take a look at our website at gameoftrades.net. We recently posted a video talking about the Dow to gold ratio and the massive power that gold has as a hedge against the financial system, and exactly when we think it's going to be time to start positioning in those assets and reduce risk in our equity portfolios. We have every intention on following these markets day to day, week to week, month to month, keep everything into a historical context and come out on top after what I believe is going to be one of the most volatile periods in stock market history. If you enjoyed this video, make sure to click on that like button. It really helps our videos out massively. Now, in the meantime, I wish you good luck on your trading and see you next time.